Hello fellow traders. Today we'll explore this critical skill every trader and investor needs, spotting market tops before the herd. We're going to be using Apple as a real-world example to understand price behavior, volume, and psychology to help you become a proactive trader rather than reactive. Today we're going to get into how to spot market tops before everyone else. And if this video resonates with you, give it a like and subscribe. Let's get into it. The anatomy of a market top. Final price surge, sudden rapid price increase driven by last buyers. A volume spike, but weak follow through. Heavy trading volume, but failing to push through a higher price. Momentum divergence, oscillators, RSI, MACD, showing warning of momentum despite price highs. Sentiment peak, excessive bullishness, media hype, and analyst upgrades. The top isn't just a price, it's an event marked by overenthusiasm. When momentum fades, but the price is pushed higher by the last wave of buyers, the rally is vulnerable. Volume rises, but not because new buyers aggressively step in, but because smart money begins to sell. Case study, Apple's peak at 259.18. So I wanted to talk about Apple. Rejected at 259.18 in December. Was looking for it to take off and get higher, but rejected. And then at this level, didn't take off from here. So I waited for a rejection against these areas. And then got in here on a put. Sold half of it in this rundown, and I believe that it has further downside going into the year. I think it can get to here, so I'm holding the rest to execute in this area, but it could bounce here. Now, what does it tell me? Well, you had a huge volume sell-off right about at 230. And when it got here, it was completely overextended. And then you could see it just continued to reject in these areas. So when you're looking at a chart and you see a big volume sell-off candle like this one here, you pretty much can figure that at some point it's going to start selling off, so you just look for areas where it rejects. Price climbed steadily before peaking at 259.18, marking a clear high. Presence of longer upper wicks signals rejection near the peak price. Sharp price reversal following the peak, a classic exhaustion move. Volume sharply increasing during the final push, indicating distribution. Subsequent sharp fall as low as 168.80 confirms the validity of the top. Looking closely at Apple's chart, the 259.18 was followed by long wicks and candles, long wicks on the candles. Signs traders tried to push the stock higher, but met with selling pressure. Volume surged, signaling a battle between buyers and sellers. When the sellers took control, the price collapsed, a textbook top in action. Warning signs to watch for. Resistance holds. Price creates a double top or triple top, unable to break through. Momentum divergence. Technical indicators show decreasing momentum while prices rise. Volume anomalies. Large volume spikes during the up days without sustained price gains. And excessive optimism. Media analysts amplify the bullish sentiment, often late in the cycle. Watching resistance levels is vital. When price struggles repeatedly at the same barrier, this is a red flag. Combine that with momentum indicators like the RSI or MACD showing negative divergence, and you have a technical warning. High volume rises, during these times, attempts to often means that people are selling rather than buying. Fear and greed. The market psychology at the tops. Herd mentality. Investors rush to buy, fearing missing out. Emotional trading. Fear and greed dominate over rational thinking. Dumb money distribution. Experienced traders quietly exit while public remains bullish. Euphoria. Overconfidence blinds traders to risk, and corrections are seen as buying opportunities. Market tops are emotional events as much as technical ones. The danger is fear of missing out. That leads to everyone to buy in late. Meanwhile, smart traders distribute shares, selling into the demand. Recognizing this emotional imbalance provides you an edge. Tools to confirm a top. Momentum indicators like RSI below 70 or MACD shows the bearish crossover. Volume filters, volume above average, but price struggles in confirmation of distribution. Market breadth, declining number of stocks making new highs despite market index gains. Support levels, failing to hold key moving averages like a 50 or 200 day. And sentiment analysis, sentiment surveys, and news sentiment signaling excessive optimism. No indicator works alone. Use a smartwatch approach. Time multiple indicators and sentiment to align the signals. Momentum divergence, volume anomalies, weakening breadth, and failed support levels together make a compelling top signal. Action plan. Managing risk at tops. Early lightning. Reduce positions as topping signs appear, slowly but not suddenly. Use hedging instruments. Protective puts or collars reduce downside risk. And tightening stops. Move stop loss orders closer to protect gains. Keep cash ready. Preserve the dry powder to capitalize on later downtrends or corrections. And stay objective. Avoid emotional attachment and follow your plan strictly. The best defense is preparation. Take gradual steps to reduce risk as signals build. Never wait for absolute confirmation. Use hedges to protect gains and tighten stops to safeguard capital. Being disciplined here saves you when the market turns. Key takeaways. Tops are predictable when combining psychology, momentum, and volume clues. The Apple chart shows clear topping behavior stalled by price, volume spikes, and the volatility spike, rejection wicks. Early recognition allows advantage risk reduction and strategic hedging. Discipline beats emotion. When others are greedy, think defense. Mastering the art of spotting tops gives you the huge edge. Apple's example is a perfect study in signs of exhaustion. Recognizing these cues early, prepare to reduce risk and guard your capital. Remember, the best traders think defensively at market extremes. Thanks again for watching.